Thank you so much, Yonah, for joining us here at Dwellynn Show. I'm really, really excited. I'm your host, Ola Dantes, and we've got the amazing Yonah Weiss on the call today. Hey, Yonah.
Thank you for having me, Ola. It's a pleasure to be on with you. It's, I've listened to a few of your shows, and you always have some quality guests, so it's an honor to be a part of that list. And we're going to hopefully talk about some cool stuff.
Nice, nice. So, of course, I know about you. I've been following your work. I've heard you on different other podcasts. So, but, for our Dwell listeners, that are probably just listening to you, or probably even listening to the show for the first time, welcome, guys. Do you want to just tell them about yourself and kind of, what you've been up to, a little bit about Madison SPECS, your great company?
Sure. Yeah, sure. So, first off, a little about me. I have a real history. My background is in teaching, really. I spent about close to 2 decades really studying and teaching in various different levels. And I enjoy that very much, which is why I enjoy the podcast interviews and this kind of stuff and teaching about cost segregation and some amazing tax benefits. But, I really got into real estate a few years ago, about 4 years ago. And I started to try to just get my feet wet and learn about everything that had to do with real estate. So, I worked a little bit as a commercial mortgage broker, learning everything about the actual financing of properties and hard money loans and investing and fix and flips and that whole business. And then as a real estate broker as well, residential and then commercial development. And so I was really kind of across the spectrum on many different levels of commercial real estate and residential real estate. And I wanted to learn from, on the ground from people, mentoring, from them, menteeing, whatever you call it, and learning directly from people who had the experience. So that gave me, a real strong background in a lot of different areas in real estate. And also in terms of the fixing and flipping itself, a partner of mine, we did a number of those out in New Jersey. So that gave us kind of a feet on the ground kind of experience, and I saw from beginning to end the whole process of how it works. And most recently, past year or so, I've been working with an amazing company, Madison Commercial Real Estate. Madison SPECS is one of the branches, which is the main company I work for. Madison has a number of other services for commercial real estate. Title agency is one of their biggest, their national title agent, title insurance, especially in New York, New Jersey, and Dallas, Texas. Those are our three biggest offices. Basically, anyone you ask there knows who Madison Title is. It's a pretty big company. And another number of other services, but cost segregation is one that gets not a lot of publicity, and it's not on the forefront of most investors' minds. In fact, I found that most people don't even know what it is. And I literally speak to people on a daily basis who they have no idea. They never heard of it. They don't know what it is. They don't know how this affects them, affects their income taxes, and can positively increase their cash flow to an extraordinary amount, a significant amount. So it's my pleasure to speak with people and give them, this insight and teach them what they should already know, but, take advantage of it and save money, which is awesome.
So there is a lot of stuff in there. So I'm going to, as much as I'm tempted to jump into, tell us about, your flips in New Jersey with your partner and all that. Let's just leave that for aside for now. So cost segregation, right? Some of our listeners might know that, investing in real estate can give you cash flow, can give you appreciation, can give you tax benefits. You can use leverage, but that tax benefit is almost vague, right? A lot of people don't really understand how does this really benefit me. So just for the Dwell listeners that have never heard of cost segregation, what the heck is it?
Yeah, well, just to give a little background. You're right. The tax benefit is a lot of times overlooked. And people assume, my CPA, my accountant is going to take care of that for me. And it'll just come, automatically. Whatever the tax benefits are, they'll come. But the truth of the matter is, we all, and that's why you're here, and that's what I love doing is we're all here to learn and to educate ourselves. And so each one of us can know as much as possible about all the different aspects of investing. And this is one solid piece that everyone needs to know about. So a quick background about cost segregation. First of all, weird name the IRS gave, right? I think everyone agrees, what in the world is this? And I don't know how many people I speak to on that just get thrown off. What did you say? What are you talking about? But let's leave the name aside. But it's accelerated depreciation. That's what another name for it is. It's depreciating a property at a faster rate than the normal. So let's take a step back and talk about what depreciation is. Depreciation also gets a bad rap. It's it's negative. I want to appreciate my properties, right? You talked about, I want to make be worth more. So depreciation is based on the concept that anything that you own, property you buy, the day you buy it, it starts to go down in value, right? And everyone understands when you buy a new car, you drive it off the lot, it goes down in value, even though there's no real intrinsic value lost. But for tax purposes and for cost basis purposes of that property, it does go down in value. So the IRS allows you as an investor, as a property owner, whether it's a business property or whether it's an investment property, the only exclusion is personal residence. Primary residence, you get no depreciation for. So any other property that you own, you get this, IRS allows you to take a deduction based on the value of the property the day that you bought it. Not the value, actually the purchase price. So even if the property is valued at $10 million, but you bought it for $5 million, you got a real good bargain. So the depreciation starts at $5 million. Okay, so the first thing we do is we have to subtract land from that value, because land does not depreciate. Land is land, it stays the same, it never changes. We're going to talk about the property that's built on the land and the land improvements. So there's the building, there's stuff in the building, and then there's stuff outside the building, which is not just raw land. It may be pavement, it may be landscaping, maybe stuff like that. All that stuff actually has a life, like a depreciable life. It means that according to the IRS, stuff goes down in value over a period of 27.5 years for multifamily or residential property, and for commercial property over 39 years. So the day you buy a property, you take the value, the price, the purchase price, you subtract a little bit amount for land, whatever that may be, 10%, 15%, 20%. In some places, it can be even up to 50%, which is crazy. But that's what the property taxes might say the land value is. Let's hopefully it's going to be a lot less, which will give you more value. So now the IRS says you can take a write-off. You can take a portion of that property value and write that off from your taxes every single year. Okay, and that's what depreciation is. It's called, some people call it a phantom deduction. It means it's not really there. There's nothing really there, but nevertheless, it's not a real expense. It's a phantom expense, right? So you bought a property for $1 million. Okay, you took off land. So now divide that by 27.5, and you're left with about $30,000 each year over those 27.5 years. There's no real expense going on. Nevertheless, you deduct that from your income tax, and then you only pay tax on the lesser value of that. So that's depreciation in a nutshell.
So, okay. So thank you so much for that. I think that's a really good segue and a really good foundation to really understand cost segregation. And we can call it cost seg just for the purpose of the podcast. So with cost seg, now you're saying that we start to break the building apart? Not literally, but from a tax perspective. Can you explain that? And how can we wrap our heads around that?
Okay, so it starts like this. The building, you look at it and it depreciates over 27.5 years. But the IRS says that there's not just the building, there's actually can be broken down into different components that have different lives, different lifespans according to depreciation. So there's stuff that has a 5-year lifespan. So it depreciates over 5 years, and that will be anything that's inside the property that is considered, we call it movable property or tangible property, or stuff that's not actually part of the solid function of the building. So that can be things like appliances, furniture, and even stuff like carpeting and wall coverings and a certain type of electric work and millwork and shelving and all kinds of stuff that is in the building. You wouldn't even think it has its own separate value. But all that stuff depreciates over a faster life. And that's the first category. There's another category called 15-year property, which includes land improvements, stuff outside the building. So everything outside the building that's not actually part of the land depreciates over 15 years, which you can take that depreciation for 15 years. So that includes stuff like pavement, you have a parking lot, for example, or curbing, fences, walls, playground, let's say landscaping, you put in beautiful palm trees, those cost a lot of money, right? So those palm trees depreciate over 15 years. That means that you can take the value of that palm tree, right, and divide it by 15 years and take that deduction from your taxes. So it's really complicated, and there's all these things. So what happens is you need an engineer. The IRS says you need to have an engineer, someone who is very well versed in construction, in engineering, and also in the tax code. There's a specific portion of the tax code called the Cost Segregation Audit Techniques Guide. Okay, there's a whole guide, and it's extremely long. It's like 250 pages long, right? And it goes through in great detail everything that can possibly be in a property, every single type of property there is, whether it's a hospital or a golf course or a multifamily property or a hotel or a shopping mall, you name it, and everything that's in there or outside of it, and what that depreciation life is, okay? And how to apply those, how to find that, and the techniques, how to find those values and apply those values to get the maximum tax write-off. So that's what a cost segregation firm like ours, Madison SPECS, will do. We have engineers on staff that will come to your property and evaluate it, take pictures, look at every single thing in the property and outside the property, take down very extensive notes, and then go and like reconstruct the building. Actually, that's what they do. They take the value they bought it for and then reverse engineer it and say, if I were to put, this shelving in over here, or this, alarm system over here, or the telephone system, how much did that cost? Now, it's very easy when you're doing construction, right? When you're building a property, it's very easy. You have the budget. You know how much that telephone system costs, and you can deduct that. It's very easy. But when you buy a property, right, it's totally different. You have to reverse engineer it, right? If you built a property and the whole construction budget was $1 million, and then 10 years later you sold it for $7.6 million, right? So now that guy has to now come and reverse engineer everything that was in the property and figure out how much each thing can be allocated, the value of every detail in the property, and deduct those things individually.
Okay. Wow. Yeah, that's powerful, right? That is powerful.
Right.
So let's try to, like, for a second, bring it down. So if I'm a Dwell listener, I'm in my car driving to work, and I've been thinking of investing in a syndication or in a multifamily deal.
Right.
And the GP is telling me, hey, you can benefit from taxes. Is this part of that benefit, right? Does a passive investor, would they actually bear in this benefit, right? Would they actually get some tax breaks?
Yeah, absolutely. And that's an excellent question that everyone who's investing on any level in a property should be aware of, because this affects everyone. Let's take your example of the passive investors who are joining up in a syndication deal, for example. I think it's something like you're describing, a GP, a general partner. So he's arranging all of the investors to come together, and what they'll do is form an LLC usually. And that LLC will really be made up of all of the investors pooled together, to each one their certain percentage of ownership of the property. So let's say, you'll have the general partner might have a 30% ownership, and then the general partners would have a 70%, the limited partners, sorry, the investors would have a 70% ownership, for example. So all of those investors would now get a percentage of that 70%. So if you had 10 investors and they all, invested $100,000 into $1 million deal of that 70%, let's say, so each one would really have only 7% of the total value of the property, right? Because the 10 of them made 70%. And so what happens is the tax benefits, depreciation, gets applied to the property, to the LLC, and then flows through that LLC to each individual investor. And this happens, actually, there's a special form called the K-1s, which every investor will get from their, the syndicator which exactly shows all of the expenses, all of the income that was made, all of the expenses that happened, including depreciation, which we said is an expense, and then shows their, their cash flow for their tax returns. And that goes together with their tax returns. So yeah, everyone benefits from this.
Fantastic. So another question as a passive investor listening to this, right? So that's fantastic. So if I invest in a syndication, I also get benefits. But then I'm also thinking, why is the government doing this? Why are they allowing, people to buy, these buildings, and then you can depreciate the carpet and the damn palm trees outside? Right. Why would the government allow this?
Right. So yeah, why would they do this? So the truth of the matter is, this is a fundamental, and there are many different opinions of why this may be, but the fundamental idea is that the government gives tax benefits for those who are benefiting the economy. So people who invest in real estate and are investing in, helping people have a place to live, which is one of the fundamental, needs of every human being, is shelter and a place to live. So someone who's providing more places to live for more people is giving back to the economy. And people may argue that there may be different, philosophies of why that is, but, generally speaking, it helps create more jobs as well, especially if you're doing construction and things like that. So why it may be, that may be one philosophy. Another philosophy, which some people like to say, is that it happens to be that over 90% of Congress are actually real estate investors, or invest in real estate. So of course they want to have tax benefits, and they want to pass laws that people who own real estate and invest in real estate have tax benefits. So that's another take on the subject. There's probably some truth to it.
That's a funny one. Okay, thank you so much for that. I always try to think like our listeners, because some of these things to syndicators like myself and experts like you, it sounds very normal. There was a news about Jared Kushner, he earned 1.7 million, and then he had a loss of 8.5 million. But to someone watching that, it doesn't really make sense. But if you're in the real estate game, it makes absolute sense to you because you understand what is going on. So that's why I asked that question. So right. Another segue as well is bonus depreciation, which is also a somewhat newer law that's just been passed. Can you just tell our Dwellynn listeners a little bit more about what that is and how we can benefit from it?
Sure, and this goes to just to understand more about the cost segregation itself. I mean, the name cost is the cost of the building, and then segregated, right, is breaking down all those components into little details. So, getting stuff at 5-year depreciation, 15-year depreciation, getting the cash flow, getting those extra tax deductions so that you can actually, quite possibly, like you mentioned, Jared Kushner has not been paying taxes, federal income tax, even though he has a net worth of $300 million, right, is not paying income tax. Why? Because he has so much of this depreciation and he's utilizing cost segregation. I know that for a fact. But bonus depreciation is a brand new, or actually it's partially a brand new law. It changed, the law changed. And what it means is like this, that in the first year of ownership, you can choose to take 100% of those 5 and 15-year depreciation assets. And instead of spreading it over the whole 27 or 39 years with regular depreciation, you can do cost segregation and get 5-year and 15-year, or you can choose to get all of those 5 and 15 years in the first year, 100% of that. So, or 50%. It's actually 2 choices, 100% or 50% in the first year. So let's just take an example so we can understand this just in terms of numbers. And let's take our property that we bought for $1 million. Okay, a multifamily property. You know, I don't know how many units, say 20 unit property, sounds good deal, right? So regardless of how much income it's making, you're allowed to take an expense. So we'll separate 15% for land, let's say. So you're left with $850,000. That's called the depreciable basis. That's the cost basis of the property. Divide that by 27.5 years, $30,000 each year. Okay, that's basically basic math. Now, and I've just said that I've done a podcast a few times, so I just have that memorized already. It's rounded numbers. It's not exactly, but it's good enough for our intensive purposes. Now, what happens when you do cost segregation? Potentially, you can get 20 to 30% of the value of that property, and it really depends on the type of property, how many units there are, how many, how much land is involved, how big the building is. It really depends on a lot of factors, which is why you need the engineer to actually go and see it, to take down all the information. Because it's not just a standard deduction for each property. No, it's every property is specific and different in detail. But generally speaking, between 10 and 40, that's like the window of most properties fall into that window. Multifamily properties usually around 20 to 25, 30% of the property. So let's say that 850,000, right? 20% of that basis, you can take those deductions in the first 5 years. Okay, so that's huge. That means that you're going to be getting, $170,000 potentially to spread over, 5 years extra on top of the 30,000 that you get already from regular depreciation. Okay, so that means on a small property like that, you can get potentially, $70,000, $80,000 of deductions over 5 years. That's pretty good, especially if on $1 million property, your income is not going to be, much more than that. Maybe it is. If you do, that's a great deal. But bonus depreciation allows you to take that whole 170 and take it all in the first year. Okay. Now, what we just said, it might make sense. It might not make sense for some people to do. And that really depends on an individual basis what your tax situation is, right? So for example, if you don't have any income, it doesn't make sense to take extra deductions. You're just going to put yourself in a loss. You don't get a refund on it. Okay. You don't get a refund. That would be great if you did, but they're not, the IRS is not that kind. Okay. Someone argues that they're not kind at all. This is just the rules they set up and whatever. But that amount, if a person has other properties or has other income, they can use these deductions of cost segregation to offset that other income. Okay, so it's not just per property, right? Doing cost segregation on one property can actually be used to offset the income on other properties or even other income from other avenues, other streams. And this is one thing that we need to clarify because it does make a difference whether or not you are a real estate it's at least 750 hours. This is very important. You have to spend documented 750 hours. That means if you're analyzing properties, if you're, buying properties, if you're, going to view them, if you own properties and you're doing management, you're traveling to it, all of this, you're buying stuff for the building, all that can be documented and should be documented, and you can provide that. Hey, I'm a real estate professional. What that means is you can use all of your income, any income streams whatsoever that you have, you can use depreciation to offset all of that income, okay? And that's probably why, like that New York Times article last week about Jared Kushner, right? He had all these streams of income. He had stocks and he had, business and he had this and he had that. And yet he still had all these losses to use to offset all of it, made from cost segregation. Now, if you're not a real estate professional classified by the IRS, so you don't get so much benefit. And the reason why that is you're only allowed to use depreciation, which is a passive loss, use that to offset other passive income. So other passive income, one is real estate properties. Real estate income is considered passive income. Stocks or bonds or other passive businesses may be considered passive income, but a person like W-2 job, for example, is not considered passive income. And so depreciation cannot be used to offset that. Or it can be, but for just a very small amount of it can be used.
Wow, this is extremely fascinating. I'm like almost jumping out of my skin because this is just amazing. And obviously it's no surprise that we have this new law this year. So personally, I'm thankful for it. And I wish we can just keep going and digging into cost seg. But we definitely dwelling into the quick rounds. These are going to be quick questions, quick answers.
Okay.
Ready, sir?
I'm ready when you are.
All right, let's do it. First question. What would you say is unique about you? What makes Yonah unique and different? What separates you from the next guy or the next girl?
Everyone's unique. It's a hard question to answer, but I think I have a really great way to be able to relate to every single person out there, no matter what background they come from. And I'm an Orthodox Jew, which means I have very strict rules and laws and customs that I follow. And nevertheless, I have a college education, and I have a lot of secular knowledge as well, which allows me to really relate across the board. I'm fluent in Yiddish and in Hebrew, and allows me to a little Spanish also, poquito, but allows me to, that came from growing up in Southern California, but allows me to kind of relate to a lot of different people. And I'd say one skill that I have that also makes me, I don't know, unique, but for me, it's something that I hold a lot of value to and I'm very grateful for, is that I have a unique ability to pick up very complex things at a very fast speed and learn things, even complexity and depth skills very quickly. So
that explains the cost segregation. Explains it. And this is a good segue to the to the next question. What was the last book that you picked up, that you read, and what was the one thing that you picked up or you learned from that book?
You know what? It's hard. I actually pick up a lot of books every day. So it's not just one, but and I study the Bible and the Talmud and a lot of different other commentaries on a daily basis. But one book actually that I just read that might relate to a lot of people is well, let's see. It's actually a book I just finished called Tax-Free Wealth by Tom Wheelwright. And this is one of the Rich Dad series. He was actually Robert Kiyosaki's accountant. But I went through it again, and it just, because it has so much value, it has so much depth, and this is a perfect segue to what we're talking about. And he has a whole chapter about depreciation, which he calls the king of all deductions. That's what he calls it.
Oh,
and
wow.
Yeah, and that's a really cool book. I recommend it for anyone who wants to know more about how to get these tax advantages.
Yeah, great book.
Not just for real estate investors, but for everyone.
Yeah, great book. Last question. So you've got a ton of stuff going on with Madison SPECS. You're helping a lot of investors. What do you do for fun? How do you blow some steam off?
Do for fun. I actually have 6 kids. Thank God.
You do? Oh my God! I did not know that.
Yeah, so they're pretty fun. They keep me busy, and actually, they all, including my youngest, who's 4 years old, they love to rollerblade, all of them, and they just like skate around. And I used to play a little hockey, and I have some skills also in that, and rollerblades. So I like to go, spend some time with them and do that.
Oh man, that is awesome. That was my dream, to have like 4 kids, and then we had a baby girl, and I was like, we have 2, and then she became 1. I was like, we're gonna have can we just have her? so that I can only imagine her having children. It must be fun, as well. I can only imagine. So if I'm a dual listener listening to our conversation, and I'm like, oh wow, I like this guy, I want to connect with him. I know you're super amazing and heavy. I learned so much from you on LinkedIn. But where are you most active? Where can people connect with you?
Yeah, I mean, I'm really active in terms of social media, LinkedIn and Bigger Pockets, or those 2 channels that really I spend time on. Other than that, you can give me a call, shoot me an email. Maybe you'll put that in the footnotes or show notes or something like that. But that's it. Yeah, LinkedIn, I'm there on a daily basis. I post a lot of content and engage with great people like Ola and a lot of other investors.
Thank you so much. Thank you, Yonah. I really, really appreciate your time today. It's been an amazing conversation. I'm just so pumped. I learned a couple of things actually like that I didn't know. So I'm really excited to play this back and listen myself. Thank you so much. I appreciate it.
Oh, my pleasure. Thank you for reaching out, and thanks for having me.